You are listening to the Vocal Technologist. Spoken tech for your ears.
If you felt like the ground beneath the financial system is moving, from how you use your credit card to how giant institutions vote shares, you're not imagining it.
Not at all.
The pace of change in fintech right now is just frantic.
It really is. What we've been noticing is that the traditional structure of banking, which, has been solid for decades, is being stretched and fractured all at once.
Right.
Every single part of the money machine is suddenly up for grabs.
And that's exactly why we're here, to connect the dots for you.
Yeah.
Welcome back to the Vocal Technologist.
Yeah.
We've been looking at everything from political fights to AI infrastructure, and we see three major forces driving this. First, political pressure reshaping consumer credit. Second, the strategic race for traditional bank licenses. And third, the accelerating arrival of AI agents that manage commerce for us.
So this is basically your guide to why your relationship with money is about to get a lot more specialized and a whole lot more automated.
Okay, let's jump right in with something that is, it's pretty charged right now. Consumer credit and the political arena.
Yeah.
Donald Trump recently floated a proposal on Truth Social, of all places, for a temporary 10% cap on credit card interest rates.
Right, and the idea is framed as consumer relief, with borrowing costs being so high.
It sounds simple. It sounds like an easy win for consumers.
It does, but the financial mechanics involved make it anything but. Banking trade groups, they immediately slammed the proposal.
Of course.
Their core argument is that imposing an artificial limit like that doesn't actually help consumers. It just restricts credit access, and it could even push those same borrowers toward costlier, less regulated alternative.
Like payday loans.
Exactly. But here's where it gets more interesting than just banks complaining about profits. Fintech veterans point to this critical, almost invisible mechanism that a 10% cap would just destroy. Cross subsidies.
Okay, break that down for us. What does that mean for someone just trying to understand their credit card bill?
Absolutely. So think of the credit card business model like a big insurance pool. The small percentage of high-risk borrowers, the ones who default or carry huge balances at really high interest rates, they effectively subsidize the entire system. Meaning the revenue from those high-interest balances pays for two big things. First, all the premium perks like airport lounge access and rewards points that affluent low-risk borrowers enjoy.
The ones who pay off their balance every month.
Right. And second, it allows the bank to offer any credit at all to subprime borrowers because it helps them cover that risk.
So if you cap the interest rate at 10%, that entire subsidy just vanishes.
Precisely. If you cap the return, banks can't afford the risk. The most likely outcome is that subprime credit disappears entirely. And for those premium reward cards, banks would just have to start charging higher annual fees to fund the travel points and the lounges.
So a measure that's meant for mass release ends up hurting the highest risk borrowers and making things more expensive for the affluent.
So much for a simple fix.
Yeah, finance is rarely simple. But while politicians argue over caps, the lending tech itself is just getting smarter.
That's the adaptability we're seeing. Take Affirm, for instance. They are seriously refining their buy now, pay later model.
They already underwrite every single transaction, right?
They do, but now they're integrating richer real-time signals.
What kinds of signals?
They're looking at data points like your current account balance, your real-time cash flow trends, things like that.
Ah, so it gives them a much clearer, more current snapshot of your ability to repay right there at the checkout.
Exactly. It allows for much more informed and really more responsible credit decisions in the moment, personalized risk assessment in milliseconds.
And speaking of buy now, pay later, we have to mention Klarna. They're not just about installment plans anymore.
No, they have fully committed to becoming a digital bank. They just launched instant peer-to-peer payments, P2P, across 13 countries in Europe.
So you can just send money to friends directly.
Yep. And that aggressive move really highlights the core theme here, the unbundling of the universal bank.
Not that banks are being destroyed.
No, but their components are being ruthlessly segmented and specialized by all this new competition.
Tell me more about those competitive forces. You mentioned two distinct areas.
So the first force is the rise of what people call shadow banks. This is, private credit, money markets, and increasingly stablecoins. They're taking on the risk and capturing the yield outside a traditional bank's regulated balance sheet.
Oh, and the second?
The second is the fintech UX layers. These are the companies with the slick apps, the ones who own the customer interface. They either go through the pain of getting a formal bank charter
Or they stay as what, an over-the-top software built on someone else's license.
Exactly that. Or they just bypass the traditional rails entirely using digital assets.
And we see that carve up so clearly. Look at Goldman Sachs suddenly exiting the Apple Card, with JP Morgan stepping in. That's a huge piece of the consumer pie just shifting.
Absolutely. And that shift is fueling the next big trend, the desperate race for formal licenses. Bank charter applications in the U.S. have hit a 5-year high.
What's remarkable to me is the variety of companies applying. It's not just one sector.
No, it's everyone. You've got global neobanks like Nubank,
Payments players like Checkout.com.
stablecoin issuers like Circle, even major crypto exchanges like Coinbase.
So what does that signal?
It signals a fundamental recognition that, while software is powerful, the traditional banking license still holds immense value.
What about regulatory certainty?
Certainty, direct access to payment networks, and crucially, the right to hold customer deposits. Things software alone just can't do. It's the ultimate form of legitimacy.
So that's the regulatory layer. Let's pivot to corporate governance, because there's a fascinating story about automation taking over decisions at the highest levels.
We're talking about JP Morgan Asset Management's move to sideline those powerful third-party proxy advisors.
You mean firms like ISS and Glass Lewis?
Two dominant players, yeah. They're replacing them with an internal AI system called Proxy IQ.
And Proxy IQ analyzes data,
Yeah.
and then just vote shares across thousands of U.S. company meetings?
Yeah. That's it. And this move is so significant because JPM CEO Jamie Dimon has been a really vocal critic of those proxy firms.
Especially on ESG issues, right?
Exactly. Environmental, social, and governance issues. So instead of relying on external consultants with their standardized approach, JPM is betting on its own AI to internalize control and tailor votes to its own interpretation of fiduciary duty.
It's about taking back the steering wheel from the gatekeepers.
And this intense specialization, this automation, it only accelerates when we look at the future of transactions, the shift to agentic commerce.
That's the next massive frontier.
Yeah.
We should probably be clear on what that means.
Yeah.
Agentic commerce is when an AI or a digital assistant initiates a payment on your behalf, automatically.
Yeah.
Without you needing to click a button.
The ultimate invisible transaction. And the infrastructure build-out for that future is happening as we speak. Look at FIS.
They launched an industry-first platform with Visa and Mastercard, expected by early 2026.
And this is a critical defensive move by the banks. This platform is designed to let banks securely support AI-initiated payments within the existing card networks.
So instead of being bypassed by these new digital agents,
The banks remain central to the transaction. They can enhance fraud protection as this scales up. The infrastructure is being built to make the bank an authorized partner in the AI's actions.
and this is happening across the big tech platforms too. Google's rolling out a new open standard for AI shopping assistants.
With partners like Shopify, Walmart, Target.
And the goal is seamless product discovery and checkout using Google Pay directly within Google Search and their Gemini AI.
Then you have Microsoft attacking this from the enterprise side. They're embedding agentic AI across the entire retail value chain.
Merchandising operations.
And even a co-pilot checkout for buying something right inside a chat interface. AI is becoming native to the retail experience.
But this rapid automation creates huge new risks.
Oh, absolutely. The industry is already planning for it. Visa and Mastercard both expect that by 2026, digital identity and agent authentication will become critical.
Because of all the new AI-powered fraud vectors.
Right. If the AI is acting on your behalf, who proves it's your AI?
Identity and authentication, the new gatekeepers of invisible money. And that invisibility is fueling the B2B world in a huge way. WEX is forecasting something like $7 trillion in embedded payment volume by 2026.
That number is massive, but it speaks to a real change in how companies operate. Embedded payments means the transaction just disappears into the workflow.
So instead of logging into a separate system to pay a supplier,
The payment happens automatically when your ERP system registers that an order was fulfilled.
right, payments stop being a step you take, and they just become an automatic line item in your software.
Exactly. And to manage this, data enrichment is vital. MoneyHub is deploying its AI engine across nationwide 16 million customers
To do what?
to categorize transactions, add richer context like location, merchant ID. This doesn't just help customers manage spending, it helps flag subtle fraud faster and enables more personalized products down the line.
All of this brings us to the final frontier. How crypto firms are building institutional-grade infrastructure to compete head-to-head with these traditional fintech giants.
We're seeing a major strategic pivot toward the enterprise. Take the new partnership between Stripe, the titan of online checkout, and Crypto.com.
This allows consumers to complete checkout using crypto balances.
Crypto-funded checkout. Stablecoins are the most logical driver here, obviously, but adoption really depends on how comfortable the average consumer gets with spending digital assets directly.
And while Stripe is dipping its toe in, others are trying to build the entire financial stack themselves.
Polygon Labs, they've committed over $250 million to acquisitions, pushing them way beyond just being a blockchain infrastructure provider.
They bought CoinMe and Sequence. That's a fascinating combination.
It is. CoinMe adds the licensed fiat on-ramps and off-ramps, the bridge between traditional money and crypto. And Sequence provides the wallet and cross-chain infrastructure.
So this positions Polygon to challenge players like Stripe directly.
By building a regulated, integrated stack from the ground up, controlling the entire process.
And compare that to Ripple. They're staying private after a massive $500 million raise, which valued them at $40 billion.
Their strategy is a bit different. Less building, more acquiring. Their plan is to use that huge balance sheet to build a full-stack enterprise crypto platform for institutions.
Right, for institutions, not necessarily the consumer. But the major disconnect we see here is that Ripple's private valuation has just soared.
Reflecting investor confidence in that strategy, yeah.
While their token, XRP, has really lagged in price. It underscores a growing separation between a private company's fundamentals and public digital asset sentiment.
And this whole race comes down to institutional readiness. Institutions demand pristine compliance and regulated custody.
Which is why Fireblocks bought TREs for $130 million for crypto tax and record keeping.
And why BitGo is targeting a $1.9 billion IPO just based on its regulated custody services. They're building the boring, reliable infrastructure that institutions need.
So if stablecoins are the foundation, the next logical step is tokenized stocks.
It has to be. Redefining global equity markets by enabling fractional ownership, 247 trading, and real-time settlement.
To tie this all together for you then,
Yeah.
the financial world is becoming hyper-specialized, that unbundling we saw, and increasingly automated, thanks to agentic AI.
And investors are definitely betting on it. Global fintech funding rebounded a very healthy 21% in 2025.
It's a huge vote of confidence. But let's leave you with one final thought on the complexity of wealth and how quickly regulation is struggling to keep up.
Consider the proposed California billionaire wealth tax. Critics are warning that the language could tax founders based on their voting control via supervoting shares, not their actual economic ownership.
So what exactly are supervoting shares?
In simple terms, they're shares often held by founders that might give them, say, 10 votes per share, while regular shareholders only get 1.
It guarantees the founder stays in control even if they only own a small economic stake.
Exactly. So if the tax is levied on that control, on the valuation of that voting power, instead of on the actual liquid wealth the founder has,
It could inflate their taxable wealth far beyond what they practically own.
and when you see these massive venture success stories, like an early investor turning $1 million bet on Revolut into $2 billion, the scale of this digital wealth creation is just staggering.
So the core question is, are tax and legal structures actually prepared to handle wealth that is illiquid, tied to these new governance models, and subject to valuations that can just skyrocket overnight? That friction point taxing control versus taxing economic reality is a conflict that is only going to intensify as finance gets more fragmented.
Spoken Tech for your ears.